Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I'm going to talk about PayPal. Going to go over what they do, quickly look at their latest earnings report, and then I put together a little analysis sheet that I'm going to use to figure out whether PayPal is interesting to me as an investment at today's prices. Remember guys, this video is for entertainment purposes only. So please do your own due diligence, talk to a financial advisor before making any investment decisions. We are also going to talk about the new CEO and what he did. So let's start there. That was one of the most recent announcements. PayPal recently announced that they're going to hire Mr. Alex Chris, formerly a leader of the small business and self-employed group division at Intuit. Intuit, the the tax business. This guy kind of led their MailChimp acquisition in 2021. Sort of an expensive acquisition, but beyond that, this business, this self-employed group business has done pretty well for Intuit. And Intuit as a company has performed very well as well, which can't really be said for PayPal in the last couple of years. So it's an interesting hire. This guy's been with Intuit for 19 years. Kind of hard to tell how he's going to do with PayPal, but it's always nice to see some fresh blood in the leadership position, especially for a company that's kind of been stale for a while. Some of the acquisitions they've made in recent years haven't been all that amazing. So it'll be interesting to see if Mr. Chris can do something different, if he can make a transformative acquisition, if he can help the company grow just like the small business segment grew at Intuit. That segment grew in the 20+% range. PayPal's not really there anymore, but PayPal is also a much more mature business. So speaking of PayPal's performance in the last couple of years, this is a stock that was basically in the 60s in 2017, flew all the way up to 300, and this is a stock that I used to own. But as it got into that $200 range, it got kind of expensive for me, so I got out of there. But now that it's fallen back to $60, it might be interesting again. So I thought it'd be nice to look at it again, because a stock that can get punished this quickly can certainly get into an interesting buy range again pretty quickly. And if you look at the year-to-date performance, down 18%, the one-year performance down 35%, the five-year performance down 32%, certainly an okay performer since the IPO in 2015. But even then, you haven't really made that much money. So as an investment for people that held PayPal long term, it has not paid off because it had very quick ups and downs, right? It flew all the way to 300. And if you were able to kind of get in and out during that period, sure, you did well. But if you've held it from even IPO or anytime after 2017, you are in a losing position since they do not pay dividends. So that's tough as an investor, but also important to note that that doesn't mean it's a bad investment going forward. So we'll see how they look there. Kind of taking a quick look at their latest earnings in August of 2003. They're still growing at an okay basis. So if you're not familiar with PayPal as a company, I think most people are, but they're essentially in the payment processing, money transfer space, right? You're looking at paypal.com is their most familiar website, kind of where you go to transfer money, to use branded checkouts at certain retailers. I think I use PayPal when I buy stuff on Steam for whatever reason, but I do it. I don't love PayPal. I don't use it all the time. It's kind of, they've made it a lot easier. But back in the day, PayPal had a tendency to sort of shut down your account. It was a pain in the butt to kind of get your money from time to time if you were using PayPal for any sort of payments that you were receiving, especially as a small business, etc. So some people dislike it for that. But at the end of the day, it is a pretty good product. It is relatively seamless these days if you're just using it as a consumer. If you're using the branded checkout part of their business where, hey, you're using PayPal to buy something on whatever website you may be using or whatever business you may be working with. They also have Venmo. Venmo is kind of a verb these days. Hey, Venmo, use some money. Venmo and Cash are kind of the two interchangeable websites, but whenever I have to send anybody money on my phone, I'm using either Venmo or Cash, and most of the time it's Venmo for whatever reason. It seems to have the mind space these days with a lot of consumers, which is a good thing to have. They also have other stuff, like they recently acquired Zettle, which is kind of a point of service thing in the realm of Square. You know, those scanny thingies. You go to a store, they have an easy way for you to use your phone to buy something, etc. They have Honey, which is a basically a coupon browser extension that they acquired for 4 billion. Again, I kind of harken back to those weird acquisitions that they made. I don't know if I loved that acquisition as an investor at the time when they bought it. They also bought Paydi not too long ago in that buy now, pay later hype cycle that lasted all of 6 months. I think Afterpay, Square paid 30 billion for Afterpay, so at least PayPal didn't spend 30 billion on this. Something that's probably worth close to nothing these days because they paid 2.7 billion for Paydi. They still have a buy now pay later business, but as you'll see here, they're kind of selling a lot of those receivables to KKR, getting some money and kind of moving away from that business a little bit, trying to get that out away from their balance sheet. But in essence, you know, they are very much in that payment processing space. They also have a white label payment processor that a lot of people aren't familiar with. Braintree is kind of getting as big as ADN, kind of getting as big as Stripe. Those are names you might be familiar with. Braintree does not get anywhere close to the margins that those two companies are getting because they have a lot of larger clients. So from a payments volume, they are getting a lot of payments volume, but their margins are way smaller than those other guys because their clients are large. So I think they have deals with Airbnb, maybe Uber, right? So those companies can basically command really good deals. So Braintree might not be making a ton of money, even though they are getting a ton of volume through the book. So you can kind of see, hey, total payment volume is growing at 11% for PayPal versus revenue growth of about 7 to 8%. And that revenue is growing at a slower clip than payment volume because their margins are actually contracting. And margins are contracting, and we'll talk about that soon, because that Braintree white label volume is growing more so than the volume from PayPal, which is their branded higher margin product. But at the end of the day, they are still making money as a company. They have, 24% growth on non-GAAP EPS. Don't really care about EPS. We'll look at free cash flow later. They announced a multi-year agreement to sell their European buy now pay later receivables to KKR. So they're essentially going to kind of move away from that as a profit center of any sort, get that from their balance sheet, but they're going to get some money from that at close, which they're going to likely use to buy back shares if they feel like they are undervalued. So revenue growth, pretty good. Talking about transactions here, going to kind of go through this quickly. Free cash flow is actually negative for this quarter, but that includes a negative impact from the health for sale loans. So really, if you exclude that, we're talking about 800 million in free cash flow without that one-time adjustment, which is, I think, a real one-time adjustment. So the 800 million in free cash flow is probably a real free cash flow. And you're talking about a company that generates about 5 billion in free cash flow on a 12-month trailing basis if you exclude the impact of those held for sale loans. So as you look at the stock itself, it's about 67 billion in market cap, generating 5 billion in free cash flow. We'll see if that's growing, but that's a pretty good number. And so why is the stock being punished? Well, maybe a couple of reasons. We'll talk about that soon. But again, this is a company that has scale. It's a two-sided network with more than 400 million consumer accounts, ton of merchant accounts, 1.4 trillion in payment volume, tons of payment transactions. We kind of talked about what they do here, doing some other stuff here, talking about that KKR loan sale. It's essentially, you're optimizing the balance sheet, unlocking free cash flow for other things. Probably a good move. I don't love the buy now, pay later business. I don't think the market loves it anymore. So I think you'll see a lot of these businesses sort of move away from that buy now, pay later stuff because it's not really what they want to be doing. Year-over-year growth of total payment volume is growing, and I think a lot of this is Braintree. You can kind of see that their peer-to-peer total payment volume increased 2%. Venmo total payment volume increasing 8%, but Braintree is probably growing that total payment volume at a much bigger clip and driving a lot of that growth. And while that's a good thing, that can also be a bad thing because of the margin pressure that puts on them. So active accounts are slowing. If you kind of look at why is the market reassessing this company? Well, your active accounts are basically slowing to a dead crawl and or shrinking. You went from 435 million at the top down to 431 million. So a little bit of churn. They're kind of focusing on some of those higher activity level accounts and existing active accounts versus other accounts, and maybe closing some of those old debt accounts that are not being used anymore. Revenue is also starting to kind of slow. It's still growing, but growth is certainly slowing. We'll see that as we look at their financials. They are working on optimizing their operating expenses. But I think one of the issues here that we'll run into is that a lot of their business is based on total payment volume. That's growing, but it's growing in an area that puts pressure on their transaction margins, and those directly flow down to their bottom line. So revenue is going to grow at a slower clip, even if payment volume is growing at a decent clip, right? Payment volume is actually ticking up, but a lot of that growth is coming from Braintree, which leads to margin compression, which at this point, it's not a good thing, but I think there's the possibility for this margin to expand again if they can kind of work on getting Braintree's margins up a little bit. And I think as you sort of grow that business, as total payment volume increases there, maybe they can deliver some operating efficiencies within that area of the business and again return to growth. So let's look at the financials here. This is really the important thing. What I've done here is I've put together a sheet that kind of looks at historical cash flows and then estimates them going forward, maybe makes some assumptions around what the market is pricing the company to today, what kind of buybacks they're going to make based on what the market's going to price it into the future, and then delivers an expected annual return based on those assumptions. So again, this is illustrative only. Don't bet on this as a must-have, but it's one way to look at it. It's a simple way to look at it. I think there is value in simplicity sometimes, and I like to look at this from a simplistic aspect. So I've got the number of shares here that I pulled from Ticker. I pulled a lot of this other information from Ticker, which is a website that I use to pull a lot of historical data from. And then I've pulled the estimates all the way up to 2027. So it's a 5-year estimated projection and a 5-year look forward on this analysis. And then using that information, I kind of figured out, hey, what is the market pricing this to today? If these estimates turn out to be true and the market continues to have the same free cash flow yield valuation 5 years from now, what is the total return going to be based on some sort of buyback assumption? So here's what that looks like. Today, the market is pricing this, we're sitting at 61.05 as of right now. This is a full look back. So I'm going to freeze that today just so I can make sure that we're not working with a number that's constantly changing. So this all assumes a price of 61.05, and I have some various scenarios I can plan out over here that allow me to change the valuation because some of these estimates seem a bit high. So I'm looking at estimates that kind of show slowing growth in 23 and then a return to growth in 2024 and even better growth going forward, which seems optimistic margins that are shrinking in 23 and then kind of growing again starting in 24. Again, seems optimistic. These are estimates from analysts out there. And again, as you go further out, 26, 27 probably has one or two analysts, so they're not very useful. But we can make our own estimates and kind of go from there. So today, the market is pricing this at 61.05. Based on their cash flow in 2022, you're paying $67 billion for $5 billion in cash flow, and that's a 7.6% cash flow yield. That is pretty darn good when you look at a risk-free rate of about 5.5%. Whether that risk-free rate is going to hold beyond 2 years, given the uncertainty around market dynamics and what's going to happen with the rates, that is certainly a question mark that is going to impact valuations. But those rising rates in recent years is certainly what's driving some of these companies that had $300 stock prices down to reasonable levels that makes them interesting again. So if the market is pricing this at a 7.6% free cash flow yield, and free cash flow is expected to grow to about $8 billion by 2027, 8.8 billion, if you truly believe that, then you can make the assumption that at a 7.6% cash flow yield, which is what the market is pricing at today, this is going to be about a 116 billion market cap company. And that is a reasonable assumption. Essentially, what you're saying is that there's going to be no change in valuation, but the company is going to grow at a pretty decent clip. On top of that, you can also assume that this company is going to continue to buy back shares. They have a $5 billion buyback plan right now. If you look at what they bought back in shares in 21 and 22, even accounting for stock options and things of that nature, it's about $3 billion a year in the last 2 years. So I'm making a pretty safe assumption that 40% of their cash flow in the next 5 years is going to go towards buybacks. That's about $14 to $15 billion. If you just kind of say 3 times 5, that's $15 billion. If they do what they've done in the last 2 years, going forward in the next 5 years, that is $15 billion in free cash flow shares. And I've made some simplistic assumptions that they're going to buy back at similar prices to what they're ending up at. Again, this buyback yield is kind of an estimate. Essentially, the buyback yield is higher when the stock price is lower, as they're able to buy back more shares. The buyback yield is lower as the stock price is higher because they're able to buy back less shares. And what I've done here is I've priced out multiple scenarios as to how the market prices this company. Right now, the market is pricing it to a 7.6% free cash flow yield, but there's a variety of scenarios that, hey, maybe the market is less optimistic about this company in 2027, and at that point, the free cash flow yield you're getting is a 10% free cash flow yield, all the way down to being a lot more optimistic and getting a 3% free cash flow yield in 2027. And if you kind of look back at, well, what has the market historically done here? There have been spots in the history of this company, if you just kind of go back to 3 years, where this stock had a 2% free cash flow yield. That was when they were at $300. So the market has priced it in the past at a 2% free cash flow yield. It's now just reassessing that valuation and pricing it at a much lower level. So this kind of gives you an idea as an investor as to what the variance of pricing may be if these estimates come to pass, right? And essentially the baseline would be, well, the market's not going to change its valuation view of this case. And if that's the case, then this company is going to give you about an 11.6% return, an additional 2.7% buyback yield, and a total return of about 15%. So if you believe that's true, that seems like a pretty good return to me. The reality is if this company were able to start growing again, if the next couple of earnings were to show an uptick in revenue, an uptick in margins to this level, then I think a 7.6% yield for something like that would be a bit conservative. And I think the market would reassess this more into this 5 to 6% range. But really what I look at when I look at something like this is, hey, today it's at 7.6. If it can return to growth, it could certainly get better. So you can kind of get into the 7 to 5% range. If the company keeps shrinking more, it could get worse. So you're talking about the free cash flow yield getting worse. But in essence, what I'm saying here is that maybe the return potential here is in that 13 to 23% range, depending on how the market values these financials if they were come to pass. But that's not reality in my mind. The reason for that is, their margins are shrinking. They're not going to suddenly jump back up to 22% and kind of stabilize at 150 basis points higher than they are now. The revenue is shrinking. Are they going to be able to grow that in 2023 and 2024? I doubt it. And then return to 16% growth when they're a much bigger company. I really, really doubt that, right? That seems very, very optimistic to me. So that's just one way of looking at it, but it's not how I would look at it. So when I look at something like this, I sort of take a look at what's more realistic. And you can kind of pencil out whatever scenarios you want to look at. For me, I sort of say, well, we're seeing an estimate that's about 7.8% growth and 17.8% free cash flow margins in 2023. I think if I want to be an optimistic investor and view this as an entity going forward, you have to say that maybe that's what happens until 2027. If they can maintain 7.8% growth all the way up to 2027 and keep their margins where they are in 2023, despite growth from something like Braintree, they're probably expanding their margins on that product if they want to keep it this way, because that's certainly growing at a faster clip than everything else, then this is probably more realistic, right? This is a more realistic view. It certainly doesn't mean it's going to happen, but it's certainly more realistic than what the estimates have them up top. And in this scenario, I'm assuming that they're going to use a bit more of their cash flow, again, trying to kind of tie back to that $15 billion buyback in the next couple of years. And I think this is good use of their money. They are, if you're valued at 7.6% today, it's hard to find a yield on their cash that's going to give you more than 7.6%, especially if you think this stock is going to grow in the future, as you should as a manager of this company. So they're certainly going to use a lot of that money to buy back shares, and 50% is reasonable to me. They've already announced they're going to use some of that buy now, pay later money to buy back shares, and they already have a $5 billion stock plan in place. So 15 billion across the next 5 years does not seem that unlikely. You can certainly make an assumption that it's going to be more or less that is going to impact your return, but they have to use this money for something. Buybacks seem like a good idea. They certainly have the ability to drive some revenue and or margin growth via an acquisition, but that's kind of a question mark. If they do something interesting there, that could provide some upside. If they do something dumb there, that could provide some downside. But buybacks are kind of locked in. You know what you're getting when you get a buyback, especially if you're buying it at lower prices like you are today. So with this in mind, again, we look at a free cash flow yield that stays the same as today, and that kind of takes your total return to about 10.8%. And a lot of that is coming from buybacks at a price point that's not that much higher than today. So if they can buy back shares at a low price for a long, long while before the market starts to reward them for their growth, then that's a good thing as an investor. If not, then maybe the buyback yield will be a bit lower. For me, a 10% return at a current free cash flow yield of 7.6%, if the market doesn't revalue it at all, doesn't tickle me as amazing. But it's not bad, right? That is not a bad return because you're essentially getting a 67% price appreciation inclusive of your buyback yield across those 5 years. You're looking at a stock price of about $102 by then. Pretty solid return. As an investor, you might be looking for a bit more because the risk is there that this company doesn't keep their growth all the way up to 2027, that their margins shrink, etc. So if you're looking for a bit more and you want to say that, hey, the market's going to keep valuing it where it is, maybe you need a lower price. However, you may also feel that by 2027, interest rates are going to be lower and the marketplace is going to value these stocks at a different price point. So if you think that, hey, maybe a 5% or a 6% free cash flow yield based on their free cash flow in 2027 is more accurate, you're looking at a 15 to 18.9% return. And that's not bad. And I think that's reasonable. I think that a 7.6% free cash flow yield on a company that continually generates cash, that if they can continue to grow their free cash flow by a decent clip, you're essentially saying that they're going to grow free cash flow by about 7 to 8% all the way up to 2027. A 5 to 6% valuation on a free cash flow basis is not bad. And it could even be better, right? If the economy tanks and PayPal kind of does okay during that period, they're in a spot where they can weather a storm, an economic storm, because they are a free cash flow generative company. Even if their revenue drops, their margins are decent. They can continue to sort of generate free cash flow on a lower revenue base. They were making free cash flow when their revenue was a third of what it is today, and they can probably continue to do that if that were to happen going into a recession. So they are not going to go out of business, right? That risk probably isn't there with PayPal. There might be some pressure on their free cash flow generative ability, but they are probably going to be able to weather a storm because they don't really have any debt. They have $9 billion in cash and about $10 billion in debt, so it's essentially paid off. And they are able to generate free cash flow during most economic times. They did okay in 2020. Obviously, they sort of benefited from the boost in online spending. I don't think that's changing anytime soon. There's a bit more competition now with, Apple Pay, Google Pay, all of that stuff, but they are doing a decent job of sort of putting themselves within that ecosystem as well and continuing to grow albeit at a slower clip, and the market is sort of punishing them for that slower clip, and that makes sense. But if they're able to do something to grow a little more, if the market starts to revalue these companies due to rates shrinking, this could be a very good investment, right? Because your baseline here, based on these assumptions, is kind of a 10.8% return. And that's not bad. And there's upside there if the market starts to value these companies at a better rate. So pretty good here. Maybe if you're an investor that's a bit more conservative like I am, you're looking for a slightly higher return here. Maybe you're even looking at some downside protection if the market starts to value this at a lower free cash flow yield for whatever reason, because sometimes these companies just fall out of favor for a while. Let's say you go to a $55 price point, which is about 10% lower than it is now, kind of takes you to a 10% return at a 9% free cash flow yield, a 13% return at the 7% free cash flow yield, and then there's more upside if the free cash flow yields get better. So when I look at this stock, I did buy some shares around 58. So FYI, I do own this stock at about 58 bucks. I do like this company at that level because I think the upside is potentially substantial. I could see this company getting a little bit of an uptick in valuation once and if rates start to come down. If you look at this company from a 4 to 5% free cash flow yield valuation, you're looking at a 20 to 25% return annually if these revenue growth and free cash flow margins come to pass. And that's not too bad. That's at a $58 price point. But I am also aware that this company is not really loved by the market right now. If there's an earning call that comes out where there's further pressures on margins, if you kind of look at this from a, hey, margins are being pressured some more, growth is slowing down, there could be additional pressure on this stock. So keep that in mind. And it could also be a stock that could just kind of meander in this range for a long, long while, right? The stock went up really quickly to 300 and then fell back to 60 pretty quickly. I could also see this company just sort of sticking in that range. It could be range bound in that $50 to $70 range for a while as the market kind of figures out where this company is heading. And that isn't necessarily a bad thing for PayPal. If they are able to sort of use this $5 billion in free cash flow they're going to generate to buy back shares at $50, that is just going to improve that buyback yield you're getting as an investor, because at the end of the day, the buyback yield is going to be much higher at lower price points than it is at higher price points. If I do feel like they're going to be able to reach these $7 billion free cash flow rates by 2027, I'd rather them stay in the $60 price point for as long as possible, because my buyback yield is going to be a lot better. They're going to be able to buy back, $5 billion is almost 6 to 7% of their company this year, and that's pretty good, right? And if they can do 6 to 7% in buybacks for the next couple of years, you're going to be owning a lot more of the company when and if it starts to expand that multiple, and that's a good thing. So what's the negative side? That's kind of my case that I'm making for this share, for this stock, buying it. What's the negative side? Well, the negative side is growth starts to slow and there's additional pressure on margins, right? So if I look at it that way, I'm looking at this growth slowing down to 3% by 2027, free cash flow margins being pressured down to 15%, still buying 50% back. That's a lesser amount due to the lower free cash flow they generate. At 61.05, at the current free cash flow yield, that's a 5.8% return. And the reality is, if that starts to happen, you're not going to see an expansion of the multiple, right? It's not going to get better in terms of the free cash flow yield going down, meaning you're getting a better return due to the expansion of the multiple that the market is willing to give a stock like this. It's going to shrink. So maybe you're looking at an 8% free cash flow yield or even 9%, because the outward projection into the years beyond 2027 is looking worse. So now you're suddenly looking at a 3% return annually, and that's not great, right? If you're thinking that the marketplace is going to give you anywhere from 7 to 10%, maybe you need more. Maybe you're needing, 10 to 15%. And if this is your case, if this is your thesis that revenue is going to shrink and margins are going to shrink, then you probably need the stock to be at like $40 to make a case for investing in it, right? Which is another 35% off of where it is today. So is there downside here? Possibly, if there's an earnings call in the next couple of months that says, well, our margins are shrinking some more and our revenue is shrinking some more, will this stock be punished a bit more than it is today? Yeah, I think so. I think there's certainly some downside here, but I do like this stock where it is today because of the upside it potentially provides. And when I was buying this at 58 bucks, I was looking at it from this perspective. I was looking at it, well, I think my revenue and margin assumptions here are reasonable. They're not aggressive. They're not super conservative. They're reasonable. I think they're going to use a lot of their money to buy back shares. And I think if by 2027 they're still growing at this clip, the market is likely to reassess this and give it a better multiple, meaning I'm in that 5 to 6% range, which is giving me that 16 to 20% return that I'm sort of seeking. Is this a huge position for me? No. I think I would make this a much bigger position if this were to drop into that $50 range, which would again put this into that 20% plus range with the same assumptions, and sort of in that 10% plus range if the multiple shrinks. And then kind of if I go to my baseline here, it kind of gives me that, hey, 10% return on the free cash flow yield that I'm getting today, which is decent. So that position, I think I would grow it at a decent clip if it hit 50, but at 58, it was just a very small starter position for me. It's one that I'm comfortable with. It's one that I like at that price point. I don't love it at that price point. But if I were to see the stock sitting at, $100+ in a couple of years, would I be surprised? No, not at all. I think this is a stock that has the potential to kind of be in that $100 to $150 range in a couple of years. I wouldn't expect it to happen overnight. This is not a short-term investment for me. This would be a long-term play rather for me. And I plan to hold this for a while, just like I held PayPal for a while when I bought it a couple of years back. But if this does suddenly explode to $200 again, would I sell it? Totally. Right? This is a valuation play for me, and that valuation has to make sense. If suddenly this is being priced at 2% free cash flow yield like it was, just 2 years ago, does it make sense to hold it at that level? Not at all. I don't think so. Unless they show that they're suddenly growing, that they make an amazing acquisition, that margins are expanding, that could certainly happen, and maybe I'd be happy holding it at $200. But from a short-term perspective, I need this to be in that 50 to 60 range for me to accumulate my position, because that's where the thesis lies, that they're going to slowly maybe get back some margin growth, maybe stick at their current margins, continue to grow at a decent, not amazing clip, and continue to generate free cash flow that they can use to buy back shares, and also maybe to make some acquisition that is going to help this number work, right? Because can their current business model support 7.8% growth forever on its own? Probably not. They probably have to do something with some of the money they're generating before beyond just buying back shares, because there's a lot of competition in this space, and they have a new CEO. Is he going to make his mark on this company? Is he going to want to do something? I think so. Hopefully it's nothing crazy, but we'll see. Again, small position for me. Let me know what you guys think. Let me know what you guys think about this analysis. Again, it's simple. Does it make sense to you guys? Do you have any questions, etc.? Hopefully you guys enjoyed this video. Please, again, this video is for entertainment purposes only. Do your own due diligence before buying any shares. And always let me know what you guys think. And let me know if you guys want me to look at some other companies as well. I'm going to be using this sheet more often to kind of get an idea of what's interesting, because I think there's a lot of companies that are falling into a range that is starting to get interesting. Anytime you're getting companies that are yielding 7 to 8% in free cash flow and growing that free cash flow, I start to get interested from a long-term perspective. The market might not reward them in the short term, but if rates start shrinking, if these companies are able to weather a recession and then return to growth post-recession, and maybe actually make some key acquisitions during a recession, I think actually PayPal would benefit from some sort of price compression. I think they're in a spot where they're generating free cash flow. They're going to use that free cash flow to buy back their shares at a lower price. And if other shares also drop in price, they can buy them and buy some companies at an attractive valuation. And I think that's a good thing. What happened in 2021 from a long-term perspective wasn't a great thing for people that were able to get out and make 3x their money. It was, but the acquisitions that were made during that time period were not amazing, and the ability to buy back shares during that time period was not very accretive to investors. So this is actually a better spot to be a buyer than 2021 by far, if you are interested in this type of company. And I sort of am. So let me know what you guys think.